the $1 Million Apartment Formula free informational webinar, not a sales pitch. And what we're going to do today is we're just going to talk a little bit about the opportunities that are in apartments, specifically in Texas. So first thing we're going to do, I like to do this little exercise when we're waiting for people to come on the line, is just to draw a little brain teaser. We put 9 dots on a piece of paper, and you grab a piece of a pen, and you have to draw 4 lines without picking up your pen, and connect and touch all 4 dots. Give it a go. See if you can do it.
4 lines without picking up the pen?
Without picking up the pen.
And you have to touch all 9 dots?
All 9 dots. You got it?
2.
All right, we got a long way to go and a short time to get there, so let me just cut through the clutter here. And this is what's important about having just the right roadmap, so that when you're going down the road here, to think a little bit outside the box. See what happened there is we went outside the 4 dots and then connected there, and there, right? So it's kind of the same thing with real estate and investing, especially in this market, because a lot of people think that real estate crashed, when in fact it didn't crash. What really happened was, you look around and real estate is still standing everywhere. What happened was the mortgage markets crashed, and the lending environment, because everybody just got greedy. They got too greedy, worshiping the dollar, and so everything just blew up. So now it's time to face facts, and we're looking at historic record numbers of foreclosures, and we don't think that there's any. This hasn't happened because there's an excess supply of real estate geniuses or gurus, let alone financial advisors. It's funny, I was just at a party over the weekend, and somebody was talking about how, well, I'm good at what I do because I have an MBA. And I said, well, so did everybody that worked at Merrill Lynch and Goldman and AIG and Lehman Brothers, right? So anyway, it's just not business as usual anymore. And I think a lot of people are now looking back at, what is the best investment on earth? And my opinion is it's earth. It's real estate. It's intrinsic. It has, cash flow and tax benefits, and you can buy it on sale right now. So, there's been a lot of changes going on in our economy, and, we're on the yo-yo economy now. Everyone is on their own. And along with that is also real estate is not immune. So real estate is a whole new economy as well. It's a new way of approaching deals, and it's not the same as it was in the last decade. So if you haven't seen the new real estate economy, then you probably haven't seen the new dollar. And so it all starts right here. And I think this is just fabulous information. This is an interesting little stat here for the economic outlook for this year. If you're to look at how much is $1 trillion, right? $1 trillion. We've been in the United States government has been around for, I think it was 200 and what was it? Something. I missed the state. I missed the stat. It's like 200 something odd days, or 85,000 days. So 85,000 days times 11.7 million is $1 trillion, right? So since we were founded, 11.7 million a day. If that's what we spent every day, that would equal 1 trillion. A lot of the information I'm going to share with you today is from the Texas Real Estate Center at A&M, and they are a state-funded economic advisory board that's appointed by the governor. There's 9 of them, and they have about a $2 million a year budget. All they're dedicated to is doing research and analysis on real estate in Texas as compared to the rest of the country. So this is kind of the overview of what we're going to be talking about over the next few minutes, the economy, the real estate markets nationally and in Texas, and then the future prospects for Texas, what it looks like. So we'll start here, and people always want to know about the recession and how long is it going to is it time to get in? Is it time to stay on the sidelines? What's the deal? The average recession lasts about 15 months, and we're currently in 19 months. So the question now is, is this a 19-month recession, or is this looking more like a depression, right? Because in the big picture, here's what a depression looks like. There's credit contraction, there's price and asset deflation, there's household wealth devastation, there's profit compression, employment destruction. I don't know if destruction is quite the word, but it's not good. And of course, people aren't carrying as much inventory, and now we've got our federal government intrusion and trying to get things back on track. This is a nice little chart of the consumer confidence is at an all-time low. Now this is a little dated. This is in January of 2009, but things haven't skyrocketed. But it's a 78% drop since July of 2007. That's a big drop. And then here's a look at the GDP. Negative 6%. This is not good. Even the highest point we ever had in Q3 of 2003, the highest was 7.5. The second highest before that was 6.4, and that was in 2000. And now we're exactly 100% below where we were 9 years ago. So people are always wanting to know how will this end, and when will we know? When businesses start making a profit, and when the financial credit systems start operating normally, whatever that means, and consumers start spending more money, the household's balance sheets get normalized, employment stabilizes and grows, and then house prices stabilize and increase, and then of course investor confidence returns, then we may be out of the recession. So let's take a look at where we are right now in the world of foreclosures. There's a lot of headlines, and people you can't escape it. So this is what's happened in 2008 foreclosure action, and you can see in the red states, where it's red, that's real high volume. You're at 5 to 9% of foreclosure action, and you can see where we are right here in Texas. We're still pretty good shape. There's Houston, there's Dallas, San Antonio. For the most part, we're hanging in pretty good. And you can see here that this was just taken today in September of 2009. These are where it's dark red. It's very, very high foreclosure rates. And the thing is that even though in Texas we're still in good shape, and then some of these other states are in good shape, the lending environment is a national issue. And so here we are with the grossly or seriously delinquent states in Q1 of 2009. Greater than 9.95%. You got California, Nevada, Arizona, Florida, and then of course, with Detroit melting down and all the upper Midwest states struggling in production, things are not good there either. Here is the housing market unmagnificent 7. Everybody knows about California is basically bankrupt. Texas' biggest competitor is California, and where's everybody going? They have to leave California because they're broke. They're all coming to Texas. You got Florida, Nevada, Arizona. All of these, ironically, are Sun Belt states, just like Texas, right? Then, of course, you got Ohio and Michigan. So here's a look at monthly foreclosure filings on the U.S. versus Texas. And as you can see, from 2005 all the way through December of 2008, Texas has pretty much stayed about the same, actually a little bit lower than they were in previous years, while the rest of the country has just skyrocketed. The other thing that's always interesting is a snapshot of what are the foreclosure types, what types of loans are getting foreclosed on the most. Now this is Q3 of 2008, and this doesn't get updated in real time, but here's the subprime arm, in the United States, 35%. But that 35% of the foreclosures that were started only accounts for 6% of all outstanding loans, right? Fixed prime accounts for 64% of all outstanding loans, and it has a 20% foreclosure start rate. And then you've got prime arm is 13%, and they're 24%. So this right here is 77% of all the loans outstanding, and they're prime, and they account for 44% of all the foreclosures. Now in Texas, it's interesting because Texas is right in line with the national average for foreclosure starts, but on prime arms they're only 8%. And then I thought this was a very interesting stat here.